Hey guys, everywhere you look at the moment, there are headlines about a recession this year. In fact, the Bank of England has warned that the UK is on the brink of a recession.
Yes, there's a lot of doom and gloom at the moment, and understandably so. Every headline pretty much points to the recession coming our way. So what we thought we'd do for today's video is actually share with you guys some really practical things we can start to do in our lives, in our finances, to begin to prepare for the event of a possible recession. We know that the reality for a lot of people are that people's incomes are fixed and their costs are going up, they've got debts and those various things to tackle on a day-to-day basis. And a lot of people feel completely out of control. So today's video is going to be us just being practical and just sharing some everyday things that we can begin to do right now to get us better prepared in the event of a recession.
So the structure of today's video is that we're going to get you up to date with where we are today in the economy, and then we're going to give you some tips on how you can best prepare for an upcoming recession.
If you love the sound of today's video and the ideas we're going to be sharing, we'd really appreciate it if you hit the like button, because that just helps to get this video seen by many more people. Okay, so the backdrop is that the Bank of England is in a really tricky place at the moment, a bit of a conundrum. Inflation's been rising significantly, and the Bank of England is in a position whereby they've delayed a little bit in increasing interest rates, and all of a sudden interest rates have started to rise. If they do nothing with interest rates, inflation will keep spiking up, and if they spike up interest rates and quickly increase it too sharply, we will face a recession in the economy. Okay, so let's just talk about in charts. We've got 4 charts looking at different areas, looking at interest rates, inflation, GDP, and unemployment. Just want to give you guys a quick update on where we are, and then we'll jump into those tips. Okay, so the first of these is us looking at inflation. And you can see up on that screenshot that inflation, as we've all been feeling with the cost of living rising, energy prices, food costs, every cost you can pretty much imagine has been rising. You can see there that the Bank of England have forecast that inflation is set to rise to double digits, to around 10% later on this year.
Okay, so the next chart up on the screen, as you can see, is that GDP growth is expected to decline sharply. In 2023, we're expecting to see a GDP fall instead at minus 0.25%. And then in 2024, the most growth expectation is 0.25%. This will be a period of stagflation, where high price from inflation weakens demand, which leads to weak economic output.
All right, so the next chart on the screen is for unemployment. So although unemployment has been falling sharply for the last 2 years, as we've all been through the pandemic, what we're expecting to see is a sharp rise, unfortunately, of unemployment, rising to around 5.5% in the next 3 years. Now, in practical terms, it's expected, according to the numbers, that around 450,000 people are expected to be out of work as a result of that rise in unemployment.
It's a big number.
Huge.
Okay, so the final piece, as you can see on the screen, is interest rates. The Monetary Policy Committee increased interest rates to 1%, the highest it has been in 13 years. The markets are predicting that interest rates will rise to 2.25% by the end of the year. In practical terms, this will add more than £1,400 per annum to a typical 200k loan.
And this is additional money that people now have to start to think about finding.
Exactly.
Because the cost, again, tied to the cost of living, the interest rates rising, everything seems to be rising all at the same time. Okay, so let's get practical now. So we've talked about the picture as things stand now. What should we do given all that stuff we're hearing? Should we just sit back and do nothing? Or should we get proactive? Our view is that we should actually not subscribe to the doom and gloom. Obviously, there's the realities of life and there's a lot going on at the moment. But we should focus on being practical and doing certain things to prepare us in the event that we head into a recession, which seems most inevitable.
Absolutely. Definitely do not panic, but it's the time to definitely get practical, and we're about to help you guys do that.
All right, so the first tip we've got to share today is to use more cash. So we've become more of a cashless society. I mean, look at the limit on contactless payments have gone up to, I think, about £100. they're making it a lot easier for us to spend and get into debt even. Because like a lot of us are actually spending money that's not ours, and it's essentially spending money that's borrowed on credit. So, but using more cash means that you are much more likely to figure out how much you are spending, whether you're actually living within your means, which is something we should all be working towards making sure we do as we all head towards a potential recession down the line. Now, if you are feeling completely out of control with your finances, and you're feeling like, do you know what, I could do with getting a grip with my finances and actually taking full control of where things are, Mary and I have created a completely free 1-year email program. You get an email every week on Friday, helping you with various aspects of your money. Essentially everything from your habits to your budgeting, all those various elements delivered every week on a Friday. If you're interested in joining that, please look in the link below where there'll be a link for you to join, as well as above. It's had some really, really incredible reviews. Feel free to join and actually get on that journey of taking control of your finances.
Okay, so point number 2 is to lock in a fixed rate on your mortgage. As we've seen, interest rates have gone up to 1%, and the markets have forecast that it will go up to 2.25% in the future. So it makes sense now to lock it whilst it is a bit lower than it's likely to increase in the future.
All right, so point 3 is to upskill and show up more at work. Now, we've mentioned the numbers on where they see unemployment rates actually heading towards. Now, obviously, we don't want anyone watching this video to be caught up in becoming unemployed, but we all know it's inevitable that some unemployment will happen in the future as this recession's anticipated. So what we'd highly suggest is actually upskilling. We say try and do your boss's job at work. By that we mean try and do more work that means that you are becoming even more relevant to your employer. So you are seen as that person who's that reliable individual who shows up, who's ever present, but who's also making the effort to really upskill and take on more at work. Doing that not only actually earns you more money, which we all need in this time of rising cost of living, but it also means that you're less likely to lose your job in the case that there's a need for your employer to let some people go in the event of a recession.
Point number 4 is to build a bigger emergency fund. Now, we know that this is quite tricky for a lot of people who are already struggling to get by, as in people are already only buying essentials and still struggling to save. But if this is something that you are able to do, no matter how small, we would recommend building an emergency fund. And we're going to link to that above and below for you guys to check out later.
All right, so tip 5 is to create a different stream of income. So as someone who's been through a recession and also been made redundant as part of a recession, I know for sure what it feels like to actually feel like you're actually relying on just one source of income without the alternative. It's actually the fear of losing your job, knowing that, I might not have a backup. That's the biggest thing. So a big priority at this very moment, if you are in that position where you're only earning one source of income, is to really, really make effort to prioritize an alternative source of income. This not only gives you diversification and gives you a backup in the event that you lose your job, but it also just gives you that peace of mind. You feel like you've got something else that you can fall back on if things went completely wrong. As I mentioned before, feel free to join that program we mentioned earlier. It's completely free to help you take control and also grow your money. We teach you different ways you can do that simply by you receiving one email every week for the next year.
Okay, so point number 6 is to budget if you're not doing so already. So here we recommend you really having a conversation with your partner if you have one, because the last thing we want you to do is to go into a recession and you're not on the same page as your partner. So this is just an informal chat where you both sit down and you really review your budgets, your current spend, and how you can change things going forward, and it's something that you can both come to an agreement with where you're both happy.
And I just add to that, one thing you can also discuss is like the worst case scenarios. Like if this happened, what should we do? If interest rates went up again by another 0.5%, how should we deal with it? That could actually be something that couples could discuss if you're someone who has a partner. All right, tip 7 is do not sell your stock market investments, okay?
Don't do it.
There's a thing called recency bias, which essentially speaks to us making decisions now based on recent news, for example. For example, panicking and going and selling your stock market investments. actually then damaging all the really good work you've done so far of investing your money wisely. So what you don't want to do in this time of, lots of uncertainty and possible recessions is to go and sell your investments. It's the worst possible way to destroy your wealth because you're essentially selling low and potentially having to buy back high later on.
If they're able to buy again.
Yeah. So even if you've got losses now and it's looking like, oh man, I'm really hurting, I'm losing a lot of money, it's not a real loss. Yeah, it's not a real loss yet until you hit that sell button. So this is why you need to keep away from your investments. Don't keep checking. It's not real yet. Provided you don't sell, things do change and will change over time.
Tip number 8 is to buy investments cheaper and invest more for the long term. So although the stock market is volatile and the stock market is falling, it's actually a good time to buy cheap if you can. So that's if you're able to, it's definitely a good idea to buy now whilst the investments are cheap.
And speaking the obvious, they're obviously cheap because there have been significant falls in the stock market as at the time of making this video.
Absolutely. We'd suggest that you invest in low-cost, globally diversified index funds and ETFs. And we've made loads of videos about investing, but for the purpose of this video, we're going to keep it short, but you can check our very popular investing playlist on our channel.
All right, so the next one is to be aware of the potential of negative equity in property. Now, we're just mentioning this one for people who are investing in property, buying properties at a really high point in the market. So prices are super high, but it's anticipated in the next couple of years or so that prices will fall. Now, we all know there have been a lot of forecasts and forecasts carry on forever, but it seems this time round that it's actually expected that prices are expected to fall fairly significantly in the next couple of years, driven by where interest rates are going and that sort of stuff in the next couple of years. So I'm just mentioning this just so you can kind of just think about it. If you're someone who is purchasing and you've got very little equity in a property, the last thing you want is to fall into negative equity. So essentially what we're saying here is try your best if you're buying a property or if you own a property already to either pay off more of that property so you have more of the equity in that property in the event that, negative equity becomes a reality down the line.
Tip number 10 is to pay off expensive debts where possible. So we would suggest reviewing all your debts as rates rise. Expensive debts will hurt in this time, so we'd recommend focusing on those ones and paying those ones off first. We'd also suggest in overpaying in your mortgage if it's possible to do so from income coming from your side hustle or from an additional part-time job.
And a final bonus tip is please don't get bogged down by the news. If you spend too much time watching the news every minute, checking all the updates, having all those alerts, it will only really just weigh you down. Okay, so stay away from too much news consumption and also just watch out and spend more time caring for your own kind of well-being and the well-being of the people around you in these next few months as we kind of approach what's expected to be a recession in the next few months. Guys, would love to hear from you in the comments. How do you guys feel about what's going on at the moment? Obviously, there's a lot going on, costs are rising and so on. We'd love to actually hear from you what you're doing practically to start to prepare for the expectation of a recession in the next few months. Jump in the comments and react to this video and just let us know what you think more generally about the various things that are going on at the moment.
Thanks guys so much for watching. Don't forget to like, subscribe if you haven't done so already, and share this video with somebody who you feel would find it useful. And as ever guys, in all things be thankful and seek joy. Take care.
Take care people. Bye.